Almost every activity that is being carried out in this world is guided by certain principles and concepts. Today, we want to look at some principles and concepts that underpin, that guides the preparation and presentation of financial statements, which have been coined as the framework. The framework is categorized under two main headings. That is, we have the regulatory framework, and we also have the conceptual framework. With the regulatory framework, it's basically looking at the laws that guides the preparation and presentation of what? Financial statements. That's, we have the accounting standards, we have the laws of the local jurisdiction, we have the laws of the company's code. They all govern the preparations and presentation of what? Financial statements. And then in the regulatory framework as well, we have the development of a new standard procedures, the processes that the IASB goes through in the developing a new accounting standard. Today, our focus is going to be on the conceptual framework because we already have a video or a lesson on the regulatory framework. So today, we are just going to focus on what? The conceptual framework and look at what the new revised conceptual framework, which was revised in 2018, somewhere March, talks about. When we say conceptual framework, we basically mean the principles and the concept that underpins or that guides the preparation of a financial statement. We are looking at the jurisdiction in which one is supposed to operate when preparing, or an entity is supposed to operate when preparing its financial statement. We are looking at the guidelines, the procedures that are supposed to follow so that you don't deviate from the norm, you don't deviate from the consistency, the harmonization of all accounting standards. You don't deviate from that particular principle when you're preparing and presenting your financial statement. The conceptual framework was actually established somewhere in 1989 and have received a partial revision somewhere around 2010, but a full revision was done in 2018. And this, our lesson, is based on the revised conceptual framework. Now, when we say conceptual framework, the main purpose is just categorized or is just grouped into three. First, it helps the International Accounting Standard Board to develop new accounting standards that are based on a consistent principles. That is the first purpose of the conceptual framework. The second one is that it helps the preparers of financial statements to develop a new policy in treating a transaction or an event which does not have an accounting standard. What does it mean? It simply means that the framework guides management or accountants when they are preparing or they are trying to treat a particular transaction which does not have an accounting standard. It's the framework that guides those management in drafting or developing a new principle in treating that particular item, in the face of the financial statement. And then the last one has to do with the interpretation of all accounting standards. So basically, that's the three purposes of the conceptual framework. One thing you're supposed to note is that the framework is not an accounting standard. It's never an accounting standard. And it does not override any standard or any requirement in any particular standard. This means that anytime there is a contradiction between an item in a particular standard and the conceptual framework, the item that has been outlined, the requirement that has been outlined in the standard prevails. That is, the conceptual framework does not override the standard or does not override the requirement in any standard. Now the question is, why do we need the revision? Why do we have to revise the conceptual framework? The conceptual framework was revised for one or two purposes. The first one is that the new revision was carried out to introduce one or two new items like presentation and disclosure and then measurement. And then the conceptual framework also see the clarification or improvement in the definition of assets and the liability. It also clarifies the prudence and the stewardship of accounting. So that is basically why the revision was done. The new revised conceptual framework has been categorized or has been grouped into 7 chapters. Once you are able to understand all the things that goes into those 7 chapters, then you are good with the conceptual framework. So we'll take the chapters one after the other and see the things or the items that are involved in each of the chapter. So with the chapter 1 talks about objective of financial reporting. Objective of financial reporting. Now when we talk about the objective of the financial reporting, it is the fundamental chapter of all the other chapters. This means that all other chapters are derived from this objective. And when we talk about the objective of financial reporting, we are saying that the objective of a general purpose financial reporting is to provide information that is useful to an existing or a potential investor, a lender, or a creditor, so that they will use those information in making decisions about their resources that they provide to the entity. So that's basically about what the objective. But what you are supposed to note is that this is the fundamental of the other chapters. The second chapter has to do with qualitative characteristics of useful accounting information. So qualitative characteristics of useful accounting information, that is the second chapter. That has to do with chapter 2. And these qualitative characteristics of useful accounting information, we are basically looking at it to be 7, or sometimes the standard or the IASB limited it to 6. We have the fundamental qualitative characteristics, and we have the enhancing or supporting qualitative characteristics. With the fundamentals, we have the first one to be relevance, and we have the second one to be faithful representation. Faithful representation. When we talk about relevance, we are looking at 2 keywords. We are looking at predictive value, and then confirmatory value. Whether that financial statement we can rely on it to predict, and you can confirm those values that we have predicted. And we are talking about faithful representation. We are basically looking at whether that financial statement is complete, it is neutral, and it is free from error. So these are the 2 fundamental qualitative characteristics. So we're going to talk about the fundamental qualitative characteristics of useful financial information. Then we are looking at relevance and faithful representation. Then the enhancing one has to do with, or the enhancing qualitative characteristics has to do with verifiability, timeliness, understandability, and comparability. Sometimes the reason why I say 7 is because of cost benefit or cost constraint. We are saying that the benefit that will be derived from providing the information should not exceed its cost. So that is about the chapter 2. Now the chapter 3 of the revised conceptual framework has to do with the financial statement and the reporting entity. That is the chapter 3. So financial statement and the reporting entity. When we say financial statement, we are saying that it is a financial report that provides information about the entity's asset, entity's liability, equity, income, and expenses. So any financial report that provides information about that to the general users or to the general public or the stakeholders, we are saying is a financial statement. And then the reporting entity has to do with any organization that is required, or any institution that is required or has chosen to prepare financial statements is a reporting entity. This reporting entity does not necessarily have to be a legal organization. So it's not necessarily that it has registered or legal. Once the person has chosen or is required to prepare each financial statement, that particular entity, organization, or institution can be considered as a reporting entity. The chapter 4 of the revised conceptual framework has to do with elements of the financial statement. That is chapter 4. So elements of the financial statement. And with the elements, they are basically 5 in number. We have assets, we have liability, we have equity, and we have income, and then expense. With the definition which is new or have been revised from the previous conceptual framework, now asset is defined according to the new revised framework as the present economic resources which is controlled by the entity as a result of what past event. And when we say economic resources, we are basically saying that it has the right, or it has right that has a potential of future economic benefit. That is economic resources. So we say it's a present economic resources which is controlled by the entity as a result of what past event. Then with liability, we are saying that it's an present obligation, or it's an obligation to transfer economic resources as a result of what past event. That is about what liability. And here when we say obligation, we are saying that it's the duties and responsibilities that the entity has no practical ability to avoid. So once you have that obligation is placed on you, no matter what you do, you have to fulfill it. You cannot avoid it. That is about what liability. Then if you talk about equity, we are saying is a residual interest in the entity after deducting all the entity's liabilities. That's the equity. Then when we come to income, we are basically looking at increase in assets or decrease in liability that results in increase in equity other than those contributed by holders of owner's equity. Then with the expenses, we are saying that decrease in assets or increase in liability that result in decrease in the equity or owner's equity other than those resulting from distributing to holders of equity claim. So that's basically about chapter 4, that is element of the financial statement. Then with chapter 5, we are basically looking at, chapter 5 we are basically looking at recognition and derecognition of assets and liabilities. Now the standard has provided us with as to when we should capture an item into the books of the entity and when we should remove or take it off from the books of the entity. So when you are capturing or you are trying to recognize the thing in the books of the entity, that is what recognition. And before an item is supposed to be recognized in the books of the entity, is supposed to meet the fundamental qualitative characteristic, that is faithful, representation, and relevant. And it also has to meet the definition of asset and liability before that particular item can be capitalized or can be captured in the books of the entity. Then with the derecognition, if you want to remove it, immediately the asset is failing to meet those particular criteria that has been mentioned earlier on, then you're supposed to remove them. In other words, when the entity has exhausted the economic benefit embedded in that particular item or that particular asset, then it's supposed to be removed from the books of the entity. So that's about recognition and derecognition, in chapter 5 of the newly revised conceptual framework talks about that. Chapter 6 of the revised conceptual framework basically talks about measurement. Previously with the previous conceptual framework didn't go deeper into measurement. So now we have been prescribed with measurement. And here we have two categories of measurement. We have historical costs and we have current value based measurement. With the historical cost measurement, that one we always base our computation and financial reports on past prices or past standalone selling prices. In this case, you only go in for the amount that the item was purchased, and in the case where there is passage of time, there is impairment, those particular prices are being affected. And one way that we account for cost under historical based account or historical based measurement is amortized costs. Then with the current, that one we are looking at up to date prices. And here we have about 4 bases of measuring current. We have the first one to be fair value. We have the value in use that is used to measure assets. We have fulfillment value used to measure liabilities, and we also have what we call the current cost value. So that is basically about measurement. And then the last chapter, which has to do with chapter 7, has to do with presentation and disclosure. Now, in every financial statement, you are supposed to disclose all the activities that you have carried out in the business. So you have to disclose everything that has happened, and you are supposed to present. Here we are looking at two presentations. We are looking at the profit or loss, and you are looking at other comprehensive income. With the profit or loss, we are saying that is the primary source of information of the entity's performance. So if you want to look at, or if you want to know the performance of the business, then you have to go to the P&L account for that particular information. And it also is also a report that provides, or that contained information about income and then expenses. So if you are looking for information about income and expenses, it can be found in the P&L account. And then with the other comprehensive income, we are saying that it is used to recognize exceptional circumstances items, like items that are not the day-to-day activity of the entity are recognized in the OCI. For instance, if the entity is disposing of a PPE, or that is a fixed asset, is not a day-to-day activity, so that the gain or the loss will be recognized in the OCI. Or sometimes revalued, surplus is also recognized in the OCI. Any item that is not a day-to-day, that is, in exceptional circumstances, are recognized in the OCI. Sometimes recycling items also goes in here. So basically, that is all about the revised conceptual framework, which has been enshrined or categorized under the 7 chapters. We have chapter 1 up to 7, and that's basically what we have looked at. If you have any question, you can leave it at the comment section and it will be attended to. Thank you.